Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and we're going to be doing our weekly housing market update. Hope everybody's doing well. And here we go. I'm going to share my screen with you here so we can get right into this. And here we go. So we have inflation rate increase. The rate of increase has slowed, which is great. Looking at that core PCE. Bottom line is Fed's been working hard to, make sure that inflation rate increases slow down. Whether you agree with the way they're doing it or not, I wish they would just let the market correct itself rather than making things doubly expensive for everybody in the housing market. And, even though these aren't direct correlations with the Fed's fund rate, it does indirectly affect it through the bond market. So it's, one of those things we've got to deal with though, because they were fixing those rates for a couple of years and now it's not that way. So we're having to look at new home sales. Jumped. New home sales jumped in January, and we're seeing in the Phoenix area our permits are way up. New home permits are way up. Pending home sales pulled back. Um, so we saw this in the last couple of months, December, January, but we're also seeing, and these are national numbers, but we're also seeing where on the ground more people are getting pre-approvals. Pre-approvals are up. I'll show you that in a second. And that's nationally. And in the Phoenix area on the ground, we're seeing more traffic. We're seeing more offers being put in. We're seeing more properties going under contract. We're seeing more people list their homes for sale. And we're also seeing builders trying to ramp things up. So for our area, things are really healthy that way. But consumers are showing extra sensitivity to mortgage rates, which we talked about in the past. No surprise there. It's more expensive. They're going to be a little bit more picky. They're going to try and get the best home for the buck, best bang for the buck, and totally makes sense, of course. And even though these are historically, you know, average interest rates, we're just not used to it. We haven't been used to it for a very long time where they've been this high for a lot of people. So in reality, these are kind of normal interest rates historically speaking, but we're just not used to it. We got spoiled for a very long time, right? So, anyways, the Case Shiller Home Index, which is considered the gold standard for appreciation, showed that home prices nationwide rose 0.2% from November to December. So even during that seasonal time, we saw home values in December were also 5.5% higher than a year earlier. So those are all good indicators, and from a national standpoint. And so the bottom line is, we see prices going up, and across the board, pretty much across the country, it's a matter of just supply and demand. You have low inventory pretty much across the board. Even though it's increased a little bit, it's nothing crazy. Nationwide, it's nowhere. About maybe a third of where we were during the crash, because everyone wants to talk about, oh, housing crash. No, we just got fewer sales because interest rates and prices went up. So it's pretty simple. But um, you know, with that said, we also see that unemployment claims are rising during the last week. Now, this is something that the Fed has been watching. They're trying to make sure that it sounds crazy, and it really is, because people are gonna get out there, get jobs, get married, want to have kids, and have their own properties, right? But they're trying to tame this employment, basically, people getting jobs, because it slows down inflation in their mind. Okay. Which I can see their logic in that. But I think as far as, we're in a different economy than the mindset that they're in, 1970s model pre-COVID, or for COVID, a COVID model, or 1970s, 1980s model. We're in a very different economy. Okay. So um, that unemployment rates that they're looking for, they're thinking it's going to be hovering around 3.7, 3.8 to maybe 4.1. If we break that mark at 4.1, which many economists say we already have with the seasonal adjustments that they made, which I talked about the last couple of weeks, they actually lost about 2.6 million jobs. When you take into consideration also, in addition to just the regular numbers from ADP versus the BLS, which is the government organization that does it, which they're not reliable anymore from any economist standpoint. But in any case, ADP is much more reliable indicator, and they're basically showing that 800,000 people didn't return to the labor force, and that we had 2.6 million actual job losses. So when you look at the inflation and when you look at that and you look at the actual numbers that weren't seasonally adjusted with a keystroke, which are it's kind of a nonsense way of doing it. And um, even with shelter costs, they've even redesigned the metrics for that a little bit. And it's like, guys, stop trying to juice it. It's stop trying to make fetch happen. We lower the Fed's fund rate already. We know Jerome Powell's going to be leaving in about a year or a year and a half, whatever it is, and he wants a good legacy. We get it, okay, but it's time. Also, we had I'm not going to get into it in detail, but we had a few things come out from that are proposals from the State of the Union address. And all I'll say is this: uh, looking at the broker boards and stuff, looking at especially from the mortgage broker boards and things like that. And like I thought from the very beginning, and you get it. It's politics. Things people are going to say things, and they've said the same things in the past, and even those things maybe didn't even happen. But like tax credits don't help people up front. It's great if you get a tax credit. That's one reason to also own a home. But and additional tax credits are great, but that's really not helping you on the front end, right? Just lower the rates, lower the Fed fund rate, and affect the bond market. Then we'll indirectly have those lower mortgage rates, right? Uh, when let the market adjust itself. With supply and demand, it's a wonderful thing, because when prices get to be too much on their own without having to juice it one way or another, people just stop buying. Okay. If they don't find what they're looking for, or it's too expensive, they can't afford it right now, and they can't qualify, well, then they wait, right? It's just kind of the way it goes, from that standpoint. Also, that goes with investing and all those sorts of things. So, whether you're looking at the bond market, mortgage rates, and purchasing homes and stuff, people need a place to live. They're going to have babies. They're going to have families, household formations, what we normally look at for new home sales, and what really drives the market that way, and new builds that will help to really create that new inventory. So, anyway, um, one of the other things was this more the title insurance, which all it means is somebody's going to have to shuffle paperwork around, and that will actually probably in the end, some are saying may cost more. So it's just a whole nother thing, that it's just like just stop, just stop. If you're not involved in mortgages and real estate, just please stop doing things government. Just put it back the way it was, and we'll be good. Okay, we'll be good. All right. Anyway, mortgage rates fall as labor market normalizes. Okay, and we see um, all of these jobless claims and reports and stuff that we've already talked about happening, and those an explanation how we got here with the labor market was starting during COVID. It kind of goes through the whole details of this current jobs opening. We had people, that left the workforce. Some of them came back, some of them didn't. All that jazz. I'm not going to get into the weeds of it, but this is from Housing Wire. And let's see, where was it? I wanted to show you one thing. Jobs report on unemployment levels. Today's report has continued to trend of labor data, beating my expectations only because I'm looking for the jobs data to slow down to a level of 140 to 165K, which hasn't happened yet. I wouldn't categorize the labor market as being tight anymore because the quits ratio and the hires data and the jobs openings report. This also shows itself as in unemployment costs as well. These are key data for the reason we're going into the 3 rate cuts this year. So so Housing Wire is basically coming out and saying, that the employment market now has, the labor market's normalized, mortgage rates uh, uh, fall this week, and we should see more of this coming with the Fed's fund rate lowering. Now, housing data shows positive signs, mortgage apps up 19.7%. That's what I was talking about earlier. That's a great indicator. Lowest rates in over a month. Okay, so we saw some great things happening with the 10-year, which is down. See all these arrows down here. That brings us to where we are today on rates. And the week ended right about there. So it had gone down, what was it? Let's see, 3 days in a row. So that was amazing. So, Logan over at Housing Wire is saying probably May, June. Barry Abib agrees it's going to be around May, June. Barry Abib also says middle of this year we'll probably be in a recession. We won't know about it for a few months later, but this is across the country. New listing data this week. If you look at 2011 versus now, no comparison. He's just trying to say, look, when they say 2008 housing crash is happening right now, it's not. There's less number of homes being sold this past year. That is supposed to ramp up a little bit this year. We'll see how that goes, especially if they lower rates. We should see an increase. I think we're going to be closer to 5 this year. Last year we were closer to 4. I think we're in the next 5 to 10 years, we're going to see a year where we have 7 million homes sold. I know that sounds crazy, but a lot of people who kind of track this stuff also agree with that. We're going to have a crazy 5 or 10 years coming up, just because we've got so many uh, uh, people who are going to be buying homes and household formations right now in their 30s, much more than we had during Gen X, which I've talked about in the past. It's just the way the numbers. Oh, there's like what 10 or 11 million more people in that bracket than was during the crash, which was part of the reasons why we had the crash with the overbuilding. Lower population came in for first-time home buyers. We had the crash. Now we have higher number, about 10 or 11 million more. And I kind of went through this in the last couple of weeks with you. But yeah, we're going to see some big years ahead. Now, here's where we are right now: 16,880 currently, all homes active, completely active. Doesn't count what's under contract, doesn't count what's coming soon, just active, ready to go, show it today, all that kind of thing. 16,880 of all property types. Okay. So nothing crazy. During the crash here in the Phoenix area, nationwide, we're around 3.8 million. Here in the Phoenix area, we were over 50,000 homes for sale during the crash, when the crash happened. So nowhere near that. A little bit of a seasonal increase, no big deal. Um, Nothing out of the ordinary there. This is kind of hovering pretty much where it was the last couple of weeks. Not much to say there, but the Cromford Market Index under 90 is a buyer's market, over 110 is a seller's market. We're at 116. We've been right. We were at 117 for the last 2 or 3 weeks. Here we are at 116. So we actually had a little bit of a decrease. As these numbers get closer to each other, we go closer to a balanced market for demand, supply and demand. So everything's just kind of been hovering there. A little bit of a move towards that 90 to 110 range, which in the middle means you're in a balanced market, 100 being complete balance. On that, single family permits year to date here in the Phoenix area for new home builds. We're actually at end of January, year to date, as of the end of January each year. They kind of take a look at this, and we're at 2720 for 2024, the end of January. Last year, same time, we were at 1,102. So that is a huge increase there, guys, in the number of permits. So we see that builder sentiment is big time. They know that there's a lot of demand, even with these higher rates. Now they're offering lower rates. So when you look at the new build, they're offering like, I've seen 3.9, I've seen 4%, 5% interest rates at new builds, plus they're covering all the closing costs and a lot of them. Again, they're all different, but I'm telling people right now, consider the new home, right? Not just because it's new and you get all the warranties and stuff, and maybe some of the upgrades you want to pick out, although a lot of these are quick move-ins, already have the stuff picked out, but they're offering these lower rates already paid for. You don't have to even pay for them. They're already built into what they're doing. Um, so it may be something to consider whether you're, are, already own a home or not. So active listing weekly counts compared by year in the greater Phoenix area. This year, outside of 2022, going back to 2020 is really we're seeing a higher number than any of those other years except for 2022. So over the last few years, so going back to the COVID thing, so that's a good indicator because we definitely need more inventory, and we see these builders ramping it up. Some of this is new seasonal homes that have come on the market, maybe even resale, but haven't sold yet. But again, that will kind of be you know, an equalizer event, so to speak, because if somebody's selling and buying, then it's kind of a neutral zone from that standpoint. But again, some of that's seasonal, and again, builders trying to ramp things up. New home sales year to date. New home sales year to date. So this is for Maricopa and Pinell County, and we are at 1507 for 2024 year to date. Let's see, last year we were at 1324. So that is, a big increase that we're seeing happening um, when we look at January and 2023 and 2024, 1324 to 1507. So again, new home sales year to date are up. And when we look at these cities individually, Chandler is at 203. That actually moved up 7%. That's at the top of the Crawford Market Index at 203.8. That is definitely a seller's market. Say it's over 110. That's 203. Then we've got Gilbert, Glendale, Fountain Hills, Mesa, Phoenix proper, Tempe, Avondale, Scottsdale, Peoria, Cave Creek. I'm sorry, Peoria, and then those are all sellers market, and then Cave Creek and Paradise Valley and Surprise are in a balanced market. So you just so you know, kind of who has the advantage there. So, and then for the buyers' advantage cities, we're looking at Queen Creek, Goodyear, and Maricopa City and Buckeye. So, guys, that's I think all I have for you today. If you guys have any other questions, please feel free to reach out. Happy to answer any questions you may have. If you need a home evaluation and home search put together, just want to go through the process of what it takes to purchase a home, get linked up with one of our, maybe one of our mortgage brokers, or anything you wanted to do as far as even a refi, we can help you out with that. So let us know if we can help out with anything at all, and we'll see you next time. Thanks.